Welcome back. In this business finance lecture, we'll go over study problem 9-6 in page 299 from the 8th edition of our textbook. Here's a view of the problem. Let's highlight some key ingredients provided in the problem. We have a company who will finance 33% of its new investment by issuing debt, or you can consider it as bonds. The bond will have a $1,000 par value, and the net price received by the company issuing the stock will be $945 after flotation costs has been deducted. The coupon interest rate is 12%, and I assume it's a yearly bond, and the bond would mature basically in 15 years. Given that our company is in the 34% marginal tax bracket, what will be the after-tax cost of this bond? So recall that in a cost of bond calculation, we have basically three steps. In the first step, we calculate the net price. In the second step, we calculate the before-tax cost of capital. And in the third step, we would simply calculate the after-tax cost of capital. Now, in this problem, we're actually given the net price, so this makes our life pretty easy actually, so in which case we do not have to make any further calculations in step 1. Now, regarding step 2, we will simply use our financial calculator, the third row of our calculator, so let's go ahead and do that. So I reproduce the third row from my calculator. I know this is a 15-year bond, and the question is to figure the before tax cost of that, so I will put a question mark here. The net price here would be $945. This bond has a 12% coupon rate, meaning payments will be $120, and the face value is $1,000. Because the firm receives the $945, I will put a plus sign in front of it, but the payments, the coupon payments and the face value ultimately will be paid by the firm, so those will come out as negative. So therefore we can now go ahead and compute I over y, which will give us the before tax cost of capital, and this number is 12.85%. Now for the remaining last part, the after tax cost of capital, or in this particular case of the bond, is equal to the before tax cost of capital times 1 minus the marginal tax rate. The before tax cost of capital, we calculated it during the second step, and we multiply it with the tax rate. This corporation is in the 34% tax bracket, and multiplying these two numbers and doing the necessary algebra, the end result is 8.48% after tax cost of capital, and in that case it is a bond, so the after tax cost of the bond. So that completes our solution. I hope you enjoyed this lecture and hope to see you again in the following video.